Oh, I'm sorry. Let me pick you up right here. Hello, everyone. I'm ready to give my 2 cents on the upcoming CPI and how we managing this. Yeah, let's use the example of Microsoft. Briefly, if CPI comes in, we moved the tail risks. We don't think the CPI is going to surprise massively to the upside or surprise massively to the downside. It is going to come in within the expectations or slightly above or slightly lower. In all of those scenarios, you want to buy Microsoft. You want to buy stocks, essentially. The signal is as such that if CPI comes in hotter than expected, we're going to get a pullback, maybe initial pullback on the open. You buying this on a trending basis, you buying this. The signal is incredibly strong. You buying Microsoft, you buying everything. If CPI comes in lower than expected, well, off we go from the open. Too bad you didn't buy Microsoft. That's the CPI. And CPI impact on the... Well, I believe stocks are largely immune to this CPI report. But obviously CPI is going to have impact on SOFR pricing, on bonds, and on the 2-year, on the 10-year, all that, and currencies. It's going to have more impact on all of these asset classes, but once again, as I've outlined in a note in the morning, the impact is not going to be a significant one. We're not going to change the trend or anything. It's just going to be repricing within the probable trade range once again. We still have the short on September SOFR futures. We're going to hold it because we have the big equity exposure, and this is going to be our hedge for this exposure that we have. The other thing I wanted to talk about is QT and the potential tapering of QT, which was hinted at in the latest minutes by Federal Reserve. They think about potentially tapering the QT. Incredibly strange. If they do want to achieve the price stability, this would be incredibly strange of them to do. But this is the reality, that if they are even thinking about tapering, this says a lot. Let's start from the ground up. There are two ways the huge fiscal deficit spending can impact the stock market, can impact the markets, is through the QT lever, meaning issuing a lot. What is deficit spending? Treasury issues a lot of bonds and issues a lot of bonds, meaning bonds, not bills, bonds. Just the issuance, the gross issuance is high, and whatever the ratio of bills to bonds is, well, irrelevant, because the gross issuance is going to rise anyway. It's going to rise higher. And even if they keep the ratio at these strange levels at 80% bills, 20% bonds, our RRP is no more. In a couple of months, there will be no RRP facilities to draw from. And let's say they stick to that 80% bills, 20% bonds ratio. The gross issuance is going to go higher anyway, quarter after quarter, and they will have to issue more bonds. Eventually, slowly, more and more bonds. And this is how the deficit spending translates into the lower stock prices, through this impacting the bond prices through the supply and demand. And bond prices are naturally staying bid up, going higher. And this is how stocks are stagnating. But if Federal Reserve tapers QT, this all assumes Federal Reserve is not tapering QT and continuing with the 75, 90 billion dollars of QT. This means that the Treasury has to issue less bonds, just issue less in gross issuance. This means that the impact on the long bond is reduced, and therefore we are totally fine, guys. Everything is all right. Meaning, buy stocks. If they taper in QT, you buy stocks. You buy everything but bonds. It is quite clear. There's another way that the deficit and the fiscal spending, outsized fiscal spending, can impact the market, is through the inflation lever. But there are different types of fiscal spending. You can do the fiscal spending as we did in 2020 and give out everybody $1,000. Then you're going to see a significant pickup in inflation, and therefore the second, third order effects is whether the Federal Reserve is going to react to that inflation or not, and we all know this. But the current fiscal spending that we're observing is a local injections, like the PBOC is doing currently, local injections into different areas, different industries, different sectors of the economy, and this keeps overall the nominal activity very high, and the level of inflation is elevated, meaning inflation is not going back to 2%, but with this local injections of fiscal into the economy and not outright helicopter money, the impact on inflation is subdued. We're not going to get spikes of inflation back to 10-15%, but we're going to stay elevated. This is, of course, it's the question of how the Federal Reserve is going to react to this slightly elevated inflation level, let's say at 3 to 4%. First of all, the inflation target of 2% is just a bogey. It's just a joke, essentially. They can abandon it, but this will, if they abandon it, obviously, this will have impact on the long bond once again because of the inflation expectations and term premium expansion. The inflation expectation, these are 5-year inflation expectation, are still at 217. This is the way that they can impact the long bond if we're going to see this move in inflation expectation. The term premium will expand and the bonds will sell off at the long end, obviously. Even without massive issuance, let's say the next QRA comes in and they keep everything in line, market is not going to be surprised by massive issuance, supply and demand in check, but the inflation expectations expand for some reason. This will still put pressure on the long bond. That we know. But this fiscal, and assuming inflation at in 3.5% range, this nominal activity, this heightened nominal activity, is incredibly positive for corporations and earnings. I don't remember the formula and who said it, but every dollar every fiscal dollar spent into the economy eventually ends up in the as a top line earnings for the corporations, and therefore the earnings is going to be good again. And this time around, this earnings season, the thing is, the problem with expectation going into this earnings of, sell side expectations and analyst expectation going into these earnings are, they're subdued. Everybody expects a recession, I don't know, maybe. So it's not going to be hard to beat those expectations. So this earnings season should be fine, I guess. Should be quite fine. So these are the levers, and we are on the path, as I see that they talk about tapering, and they see these problems, and they accept the easy way out, I guess. Treasury will continue to manipulate the curve by issuing as many bills as she possibly can, and if there will be a problem, Federal Reserve will taper the QT, and maybe will in a year's time will restart quantitative easing. This debases the currency essentially. This keeps the long end of the curve elevated. We're not going below 3%. And this debases the currency. So in that scenario, you buy stocks, you buy everything in that scenario, essentially. So these are the thoughts. These are initial thoughts going into these reports. But we're gonna see. We need to see the next QRA report. This at the end of this month. The CPI, most likely nothing burger. You buy stocks. Thank you.